So the question at the moment is really how much conviction we see in each of these rebounds, right? Some of the indicators are telling us perhaps that appetite for participation is moving higher.
Yeah, they do. But mind you, we've had several of these rebounds through this downturn, which started earlier this year. And of course, they've all failed. I think one of the things that makes me a little bit cautious about it is the fact that we never saw the VIX get to levels in the past that were associated with a big washout. And likewise, put-call ratios have never reached extreme levels. So you could argue that whilst sentiment has moved in a direction consistent from a contrarian point of view with a rally, it hasn't got bearish enough yet. So that would suggest that there's still a bit more downside risk. And of course, the other factor is that you can read what you want to in central bank commentary, but at the end of the day, they're going to be data dependent. I think inflationary pressures will come off later this year, but in the short term, we could go through a period of uncertainty. And that could linger for a little bit longer, because even if US inflation rate stabilises at these levels around 8%, that's still too high for the Fed. And therefore, you've still got this risk that they say do another 50 basis points in September beyond the next two meetings. So those short-term risks, I think, are quite high, and they just caution me in thinking that maybe we've seen the bottom. I think the risk is that we haven't yet seen the bottom.
In the meantime, though, Australia is actually one of your preferred markets, and I guess that linkage with commodities is pretty obvious there. Is that a good place to look for opportunities if there are real stagflationary worries?
Well, it is, and I think we've already seen that this year to some degree. The Aussie share market has been a relative outperformer. It's come down like other markets, but it's only had something like an 8% fall, depending on which day you look at it, whereas top to bottom, the US almost 20%, and likewise in Europe and Japan. So the fact that the Australian market doesn't have a lot of tech stocks, so it's not vulnerable to that tightening in monetary policy and higher bond yields that we've been seeing, and it has a high exposure to commodities, and the likelihood is we've moved into a commodity super cycle, even though they got a bit overboard in the short term. Those things, I think, augur well for the Australian share market. And of course, our central bank is probably not, it's not at the hawkish end of central banks. Yes, we do have an inflation problem in Australia, but it's not quite of the order that you're seeing in other countries like even New Zealand, Canada, the UK, all around 7% or so inflation. I think the UK is in fact around 9%. Europe pushing towards 8%. Whereas in Australia, we've got inflation around 5%. It's going to go up, but it's not quite as intense as it is in other countries. Right. So I think those things augur well for the relative performance of the Australian share market.
And what about the exposure to China, where we continue to see those growth forecasts declining, as this chart on the Bloomberg shows?
Well, that's certainly a concern. And when you look at the bad days for the Australian share market, they've often been on days associated with renewed worries about China, new lockdowns or rising case counts or whatever it is. But of course, the flip side is that, it's like yin and yang in China at the moment. You've got President Xi Jinping saying, focus on COVID zero, whereas the Premier is focused more on economic growth, and trying to work out the balance between those two, I think, is incredibly complicated at present. But if ultimately China's desire for decent growth wins out, and I think ultimately it will, then that will mean the need for more stimulus in the months ahead. We're already starting to see some of that, and more pressure on regional administrators. And of course, I think that's what we've been seeing in the last couple of days with the talk from the Premier. That will ultimately boost growth. And of course, you've got the war going on in Ukraine continuing, which means ongoing constraints in terms of the supply of various commodities, which again benefits Australia.
So many different challenges around the world. But Shane, just before we let you go, going back towards the Fed, because next week we do have quantitative tightening starting. This chart on the Bloomberg showing how we're bracing for countdown to that on June 1st. We have heard from the Fed minutes that policymakers saw risk of those unanticipated effects on markets with that unwinding of the $8.5 trillion bond portfolio. Is there anything that Asian markets investors should be aware of?
Well, not really, except, this should be factored in because it's been well flagged. But of course, we do know from the period around 2018 that it can be associated with roughness in share markets. So that is is an additional risk. As that money starts to get sucked out of the US economy and hence the global economy, it could cause more volatility in markets. I guess the flip side is also that we've got to allow that the shift to quantitative tightening is a de facto monetary tightening. And it's one reason why the Fed ultimately probably won't have to raise interest rates as much as the market has at various points in time over the last few weeks feared.